Whenever the government starts talking about stepping into the housing market, it gets everyone's attention. And lately, there's been a lot of talk about new policies to make housing more affordable. But what if this isn't really about a simple fix? What if it's actually a test? That's the real question we've got to ask. Are these moves just a straightforward attempt to fix a really tough problem? Or is this something else entirely? A test flight for some of the most powerful economic tools the government has at its disposal. Okay, so first, let's cover the official story. This is the narrative you hear on the news. It's clean, it's simple, and honestly, it's very politically appealing. We're told the whole point is to bring down mortgage rates, stop big corporations from buying up all the single-family homes, and, get better outcomes for regular families. The goal is simple: make housing affordable. It sounds great, but it's really an incomplete picture. All right, now let's peel back that first layer. Because what's really going on behind the scenes is less about a quick fix and a whole lot more about testing some incredibly powerful economic levers. So to really get this, we need a new term: control surface. Seriously, think of it like the flaps on an airplane's wings. A pilot uses them to steer, while policymakers use these economic levers, these control surfaces, to steer massive systems like our credit markets to make sure things stay stable. And just like a pilot checks the controls before a big flight, that's exactly what we're seeing here. This quote from the source material just nails it. This isn't a rescue mission for the housing market. It's an experiment. It's about finding out how far these levers can be pushed before they cause a little turbulence, They're testing the limits of the system. So what are these levers they're testing? Well, there are two big ones. First, you got the government buying up mortgage-backed securities, or MBS, which are basically just giant bundles of home loans. This isn't really about housing. It's a direct line into the entire credit system. And second, you have all this talk about banning big investors from buying homes. That's a test of who gets to own what, and more importantly, who has to hold the risk. So let's dig into that first lever: the government buying mortgage bonds. You have to understand, the target here is way, way bigger than just your local housing market. This shows you the chain reaction. It's called rate transmission. And get this, it all starts with just a signal. The government just hints that it might start buying mortgage bonds. The market hears that whisper and instantly starts pricing in that government backstop. And that signal then just ripples out, affecting mortgage rates, how confident we all feel about the economy, and even the value of other assets. It's an incredibly subtle way to steer the ship. And that brings us to the absolute key point here. The next time you hear a politician talking about this policy to help homebuyers, just remember this quote: "The real message isn't for us. It's a carefully crafted signal meant for global bond traders." Okay, let's shift gears to that second lever, the idea of banning big corporations from buying up family homes. This one is all about the public message, but the real-world impact is way more complicated. On the one hand, you have this really simple, really powerful political message: we're going to help families compete against giant firms. Sounds great. But the financial reality? It's a totally different story. It's about changing the fundamental rules of who is allowed to take on and make money from the risk in the housing market. And here's the catch. For all the headlines they get, these big investors still own a pretty small slice of the overall housing stock. So a ban isn't some magic wand that's suddenly going to flood the market with houses for sale. The market reaction tells you everything you need to know. The second this idea was floated, stocks for single-family rental companies just tanked. But here's the thing about capital. It doesn't just vanish into thin air. A policy like this forces that money to go somewhere else, maybe into building new apartment buildings or buying up land. It's a reallocation of capital and risk, not an elimination of it. And this is where it gets really interesting. Any move in housing which connects credit, politics, and finance is never, ever a small move. The ripple effects are just enormous. So while these little tests are being run, a much, much bigger lever is being pulled somewhere else. Check out this number. Deregulation in the U.S. banking sector is about to unlock a potential $2.6 trillion in new lending. So while one hand is testing these little precision tools, the other is opening the floodgates. And what's really wild is the contrast. While the U.S. is basically hitting the gas on lending, Europe is doing the exact opposite. They're tightening their rules. This really highlights just how big of a deal this American policy shift is. At the exact same time, you've got other policies pulling in the opposite direction. Take tariffs, for instance. This chart shows that the cost of tariffs on things like building materials is increasingly passed on to us, the consumer, up to 70%. So you have one government policy basically working against another, and it puts the squeeze on the very people these housing plans are supposed to help. So you start to see all these hidden consequences, right? Housing policy ends up shaping how we use energy, it helps banks with more loan volume, but it also puts them in a box. And this might be the most important part. The system trades something visible, like stable prices, for something invisible, hidden fragility. It's risk that just builds up under the surface until a real crisis hits. Okay, let's pull this all together. What we're seeing isn't a fix, it's an experiment. And that just leads to the biggest question of all. Why are they running this experiment right now? Well, the timing is the signal. These specific control surfaces are being tested now because the government's old toolkit is kind of off the table. With huge deficits and inflation still a concern, they can't just use blunt instruments like massive spending or big rate cuts anymore. Housing credit is one of the few channels left they can still adjust. And this is the final, crucial reframing you have to make. While everyone in the market is busy arguing about the why, the political motivation for all this, the policymakers themselves are quietly focused on the how. They are experimenting with the very machinery of our economy.
And that is a critical disconnect. The market is reacting to today. Policy is preparing for tomorrow. Those are two completely different phases of the economic cycle.
Which leaves us with one pretty unsettling thought. All of these experiments, all of these tests have been happening during a time of relative stability. So what happens when these tools have to be used not as a test, but in a real, full-blown crisis?